Okay, in this video we're going to look at why a country aims to maximise its real GDP and what's meant by the term economic growth and sustainable economic growth. So basically calculating real GDP and economic growth, when we're looking at the change in material living standards within a country, what we're looking at is whether they have experienced an increase in their GDP. So a country that experiences an increase in their GDP or their total final value of goods and services produced will experience higher living standards. So economies must grow to cater for a growing population. So we need to produce more goods and services, or the value of our goods and services needs to increase at a faster rate than our population grows so that we experience higher purchasing power per person. So economic growth is the real growth in the value of goods and services produced by an economy over a period of time. Economic growth occurs when the economy increases the volume of goods and services it produces over a period of time. And generally we look at GDP. And GDP is the total market value, so the end price, the end selling price of final goods and services produced by a country over a period of time. We also want to adjust this figure for the effects of inflation as well, which we'll talk about in the future slide. Countries aim for what we call sustainable economic growth. So basically what countries want to grow at around 3 to 4% per year, because we think that that's fast enough that it's going to lead to an increase in GDP per capita. So if we grow at 3 to 4% per year, it should lead to an increase in income per person, and it should be, we're generally producing enough goods and services to keep unemployment down as well. So generally countries aim for 3 to 4% because that will lead to, if we have growth rates below 2%, that might not be fast enough and might lead to increased unemployment. So we might not be increasing our production by a fast enough rate to create more jobs. And that can lead to more poverty and more people having worse material living standards. Growth above 4%, so if our production grows at a rate by 4%, is generally too fast. And what will happen is, because there's such a high demand for goods and services, generally prices will go up too fast, or we'll experience rapid inflation. We also might run out of resources, so that can lead to problems for future generations because we're extracting too many of our natural resources, so we're wasting a lot of our non-renewable resources like water and minerals, and that can also create environmental problems like global warming. So we want to grow at around 3 to 4% because that's fast enough to create jobs, but not too fast that it can cause inflation or other problems associated with the environment from using up lots of resources. When we're looking at growth in real GDP, basically what we're saying is the country has grown as a whole after taking into account the effects of inflation. So what we want to do is we want to take into account whether production volumes have actually increased, and to do that we need to measure what we call real GDP. So that's an increase in economic growth after removing the effects of inflation or price changes. And it gives the best indication of material living standards. Nominal GDP is a measurement of the value of a nation's output of final goods and services before we adjust for inflation. And I'll show you what that means in the next few slides. So when we're measuring economic growth, forget about the real and nominal GDP bit for this stage. What we're doing is we're calculating the production in this year's period minus last year and then divided by last year's period. So for year 2, our growth would be 3.2 million minus by last year, which is 3.1 million, divided by last year, which is 3.1 million, which gives us growth of 3.22%. In the second year, it's 3.5 million divided by minus 3.2 million divided by 3.2 million, which gives us growth of 9.3%. So what we want to look at for GDP, it's the total quantity of all goods and services produced times by the price. And we want to take out the effects of inflation from this figure, and I'm going to show you how to do that now. So if we have a look at this year, this is the prices in year 1 and the quantity produced in year 1, and the quantity produced in year 2 and the prices in year 2. So to calculate nominal GDP in year 1, all we need to do is multiply the prices times by the quantities for each of these 3 items, which is apples, TVs and computers. And to work out nominal GDP in year 2, we just do the same thing using the quantities in year 2 and the prices in year 2. So you do 10 times 5 plus 10 times 10 plus 10 times 20, which gives you 350 for your nominal GDP in year 1, and it'll be 442 in year 2, which is 12 times 6 plus 15 times 8 plus 10 times 25. To calculate real GDP in year 2, to see what the increase in real GDP has been, what we need to do is we use the second year's output but we use the first year's prices. So to calculate real GDP in year 2, it's 5 times 12 plus 10 times 15 plus 20 times 10, and that gives you a figure of 410. So rather than using the second year's prices like we do for nominal GDP, we use the first year's prices. And what that figure tells us is how much, if we keep prices the same, how much our quantity is actually increased by, to calculate how much growth is increased by. So if we look at another example, if we're calculating nominal GDP in year 1, you just add up those 3 things, and nominal GDP in year 2 will be adding up these 3 things. So it'd be 500 plus 250 plus 250. If we want to calculate real GDP, we will do the output in year 2, but times it by the price in year 1. So if we look at this, our GDP in year 1 will be 1,000 because it's 500 plus 250 plus 250. Our GDP in year 2 nominal would be 10 times 55, which is 550, plus 12 times 25, plus 9 times 30, which gives you a figure of 1,120. To calculate your real GDP in year 2, we've just done 500 plus, that'll be 600, plus whatever 25 times 9 is, which is 225. So you would get a figure of 1,025 for that figure. To calculate the change in nominal GDP, it's the nominal figure in year 2, so 1,120, minus the nominal figure in year 1, which is 1,000, so you get a figure of 120, divided by nominal GDP in year 1, which is 1,000. To calculate the change in real GDP, you do real GDP in year 2, which is 1,025, minus the GDP in year 1, which we get from our nominal figures, which is 1,000, so it's 25 divided by 1,000, which equals 2.5%. So real GDP will generally be slower than nominal GDP because after we take into account price changes, growth hasn't been as fast as what we think it has. Okay. We also use aggregate demand to calculate growth, and that's basically the total value of expenditure or demand for Australian goods and services in a given year. And it's calculated as the total demand for Australian goods and services, which is consumption plus investment plus government spending plus net exports. So consumption expenditure is the total value of all expenditure by individuals or consumers on goods and services. So that can include spending on shoes, food, clothing, public transport, all the things that consumers spend money on. Investment spending is spending on new plant and equipment. So that can be building vehicles by companies. Government spending includes all government spending, whether that be on purchases of stationery, it can be public services wages, defence equipment, as well as more capital spending, which is spending on like roads and buildings and power generators and all the money that they spend on those areas. And lastly, it's net exports, so net overseas spending, which is our exports, what we sell to other countries, minus the amount that we import. And that gives you your total demand for Australian goods and services.